Hello everyone and welcome to today's video. In today's video, we are going to look at everything to do with return on assets. Return on assets is a very important key financial ratio which plays a very important role in making investment and trading decisions. It helps you analyze companies and gives you a broad picture about how the company is doing. So we are going to take a look at all the details related to return on assets in this video. I can assure you that once you watch this video till the end, you will have an in-depth understanding of not just how ROA is calculated, because that's covered in a lot of places, but more importantly, how to use the ROA to make informed investment decisions. What is its significance? What's the right value of ROA? So we'll cover a lot of ground on ROA. Basically, after watching this video, I can assure you that you will not have to look anywhere else for any other information on ROA. And also, this is practical information which you will be able to use in your investment and trading decisions. Also, we are going to actually go to the Finviz platform, which is a screener for those of you who don't know, and we are going to see how we can use a screener for ROA, how we can compare different companies using ROA, and how basically we can find out the ROA of a company without having to really go through the balance sheets and the financial statements as such, because this online tool provides ready-made information. So you just go there and you can find all this information. So I'm going to cover that as well. So a quick preview as to what all we are going to be covering here. We'll look at the concept of ROA. We'll look at the exact formula, how ROA is calculated. We'll look at the importance of ROA in fundamental analysis and how you can use it in your investment decisions. What's the right value of ROA? Because this is something which most people get confused. What ROA should I look at? Is 10% enough? Is 5% enough? What should be the ROA? How do you compare companies uh, based on their ROA values? Then, as I said, we'll go to the Finviz tool. We are going to be looking at how to look for ROA on the Finviz platform. How do you compare the ROAs? How do you check the ROA for any particular company? Then we'll get into the more detailed topics where we'll try to understand how can companies increase their ROA, and more importantly, some companies will try to increase the ROA the wrong way. So that doesn't really give a good information, or that's it doesn't really the increase in ROA doesn't really reflect that their operations are improving. So we'll have a look at that also. We'll understand those traps and how to avoid them, and we'll look at how professionals use ROA. So based on whatever we have gone till now, we'll see how actually people who are making trading and investment decisions, they use ROA, how they interpret the ROA values. We will then go to a concept where we'll see how ROA differs across sectors. So return on assets, you can't use it just blindly. You have to understand which sector you're working with, because different sectors have different asset requirements, and the kind of returns that they gain are different. So we'll look at how the ROA differs across sectors. We'll finally look at the limitations of ROA as well. So we have a lot of ground to cover, but I can assure you that ROA is number one, a very important tool in fundamental analysis. So you can use it to your advantage. And secondly, this financial ratio, it requires so much attention, because as if you've seen my other videos on fundamental analysis, I always keep one thing very clear. Do not complicate your analysis with tens of ratios. If you want to select just a few ratios to understand and select companies which are doing well, which are good investment opportunities, ROA is definitely one of the ratios which will be there on my list. So with that, let's get started. And before we proceed, a quick look at the disclaimer. All information that I'm sharing with you is only for entertainment purposes. This is not any kind of a trading or investment advice. If you plan to take any trades or invest your money, please get in touch with a certified financial advisor and then proceed. So first of all, let's understand what is the concept of ROA. Why do we even try to look at the ROA? So if you're trying to invest money, right, in the stock market or in certificate of deposits or anywhere else, in mutual funds, in exchange traded funds, anywhere else, what is your first question? Your first question will be, if I invest my money, what return can I expect? So think about this. When you invest money in a certificate of deposit, you're basically asking the bank, how much return would you give me? So how much interest will I get paid for my investment? Same way, when we buy shares of a company, we are basically investing in that company. We are owning a portion of the company, and we expect the management to use all that money and generate returns for us, generate income for us. So ROA basically tells you what all assets the company has, whatever assets the company has acquired, right? What kind of return do they generate on those assets? So any money that the company is raising when they go in for an IPO, they use it to either purchase land, plants, and different kind of assets, right? Why does a company require those assets? Because those assets facilitate the operations of the company, right? So if you have a trucking business, that business is going to invest in purchasing trucks. Those trucks become assets of the company. They will invest in warehouses where they may store goods. They may invest in different kinds of machinery to maintain those trucks. So if you think about it as a business, whatever capital, whatever money this company raised through debt or through shareholders equity, whatever means was used, that money is being deployed by the management of the company to create all these assets. And these assets are being purchased because the business is going to use these assets to execute its operations. So you need trucks, you need warehouses, you need repair facilities, you need maintenance sheds. All those assets are being created by the company. And these assets, how much return are they producing, how much income do they produce, is the key factor in deciding how well those assets are being utilized. So if I look at two companies and both are, let's say, trucking companies, and I see that the ROA on one company is 10%, on the other company it's 20%, then I know that given the same kind of raw material, or I should say the same kind of assets to these two companies, the second company is utilizing their assets in a much better way, because for every $100 of assets that they have, they're generating $20 in income, whereas the first company is only generating $10 in income. So the return on assets in a broader way gives you a clear cut understanding as to which company is doing better. And the important thing about ROA is that it tells you, it allows you to compare companies, right? Because you can't compare two companies which have very, very different scales or size or market capitalization or different amount of assets, right? This tells you for every $100 that is invested into the company for in the form of assets, how much returns do does the company generate from those assets? So I hope the concept of ROA, when you think about ROA, think about answering this question. When you invest your money anywhere, you want to ask this question: how much returns can I expect? Your returns on the actual stock will be very different. I'm not saying that if the ROA is 10%, then the stock price is also going to go up by 10%. No, there's not, that's not going to happen necessarily. But what I'm trying to say is, looking at the company performance, if they have a 10% ROA and another company has a 20% ROA, then the chances of the 20% ROA company to grow are much higher. Their utilization of assets is much better. Their chances of running into trouble because they run short of cash are lower. Their chances of having to dilute the shares by issuing more shares because they need money are lower, because they're internally generating a lot of returns from their existing assets. So all good things happen when your ROA is high. So I hope the concept of ROA is clear by now. So we'll proceed from here. This is the actual formula. As I said, ROA is nothing but you take your net income and you divide it by the total assets that the company has. Now, net income is something which comes from the income statement. And on the income statement, if you look at any of the websites like Finviz or Yahoo Finance, you can get hold of the income statement, and it's very easy to get the net income. Same way you can get the total assets from the balance sheet. So two financial statements are in use here. One is the balance sheet, one is the income statement, and we calculate this ratio. In fact, if you go to Yahoo Finance or if you go to Finviz, on each any of these platforms, you can readily get the ROA for any company. So it's a very simple calculation, and these figures are readily available. So the calculation wise, it's not very complicated. Then I've already covered some of these points. What is the importance of ROA? That's the key point. What exactly is the ROA used for? How important is it? It's one of the, as I mentioned earlier, it's one of the most important ratios that I would look at. For beginners also, if you do not understand financial ratios, if you do not understand the balance sheet, the income statement, you can't analyze those, don't worry, get started. And if you want to get started with ROA, because the very first question that every individual should be asking is, how much return can I expect if I put money into this company? If the management of this company is given a certain amount of money through which they can create assets, how much return are they able to generate using that. So first thing, very clearly, it tells us how well the assets are being utilized, right? I'm not going to explain this further because I've covered, I think, in enough detail. Then, as an investor, what returns can you expect? That's what the ROA tells us. I've already covered this as well. The third thing is, if you use it properly, then you can actually filter out companies. So let's say you're trying to create a short list of good, fundamentally good companies. Then companies which do not have good ROA, you automatically know that whatever money, whatever is invested into these companies, that's not being utilized properly. So why would you invest in those companies? So ROA, low ROA, basically acts as a very good filter in dropping companies which are not using their assets properly. It tells you about the quality of the management. I'm going to cover this in a bit different way later, but knowing if the management is good or not is very, very important, because if the management is not good, then those companies can turn around if there is a management change, right? So it gives you a really good input about the management of the company. And also, if you want to invest with good managers, right? Because these managers, the CEOs of the companies, they keep moving from one company to another company. So if you want to really see the track record of these CEOs, you can go and see what was the ROA like for a particular company when that person was the CEO of the company. Did the ROA go up? If yes, then you can very well understand that that CEO is really skilled at an effective utilization of the assets that are handed over to him to manage. So based on that, you can make your investment decisions. ROA does not only consider equity or debt, it considers both, because you're looking at assets, and assets is equal to equity plus your liabilities, which is nothing but your debt. So there are other ratios. The reason I brought this up here was that there are other ratios like ROE and um, in those cases, what is happening is you only looking at one side of the picture. You're looking at the money that the company has raised from the stock, from the shareholders, and not from the loans that it has taken. Now, for me, it doesn't really matter whether a company has received money by selling their shares, or have they raised money by taking loans, as long as the money is being utilized effectively, right? So for me, ROA is a composite ratio which takes into account the overall assets that a company have. And for me, logically think about it, if the assets, it doesn't matter to that extent whether the assets are being sourced with a loan or from the shareholders equity, right? You can raise these are just two ways of raising money for any company. Ideally, what we want to see is that whatever assets the company has received by either means, they should be utilized effectively. The returns on those assets should be good. So ROA is a ratio which takes into account both the things, the equity as well as the debt. So that is why I find it better than using ROE, which only considers equity. And as I mentioned earlier, ROA can be very different depending on the market cap, because if a company is worth $500 billion dollars and another company is worth $5 billion, obviously these two companies are going to have very different values of assets. So it becomes difficult to compare. ROA, basically, because it's a ratio, it's reflected as a percentage. So for every $100 of the assets, what are the returns? That ratio becomes comparable. So it helps you compare companies with different market capitalizations, different incomes, different sales, maybe even different products in the same sector. You can do that and compare companies. And lastly, it also gives us an insight into sector analysis, which sectors are asset intensive and which sectors are asset light. For example, if you consider the manufacturing sector as such, they require huge amount of assets in the form of plant, machinery, land, and the heavy equipment. So these companies are going to have a lot of assets on their books. Their assets will be huge, and so the ROA automatically is going to be low. Why? Because the denominator in that formula that we saw, the total assets are going to be really huge. Now compare this to a company which is running an online app, right? So companies which are running an online app may or may not require any infrastructure. They may just have one building, they may just own one building, and maybe 1,000 people work there, and those 1,000 people are mostly software developers. So you have 1,000 computer systems probably. So the assets, if you compare that to a manufacturing company, are going to be way lesser. So here the ROA is going to be higher. So when you're comparing tech companies, you need to compare them with other tech companies and really understand what the ROA is. And for the asset heavy industries like the manufacturing sector, you have to understand that the ROA on the other hand is going to be on the lower side. So this is one key question which I get, and that is, what is the minimum level of ROA? Okay, I'm trying to look for good companies. What's a good company? So my answer to this is, first thing is you have to use a more strict approach, because it's common sense that if a company has 50% ROA, it's obviously better than a company which has 20% ROA. So first of all, see how many stocks do you want to shortlist. Okay, let's say you're looking for just 2 or 3 stocks. Then maybe if you put the ROA greater than 50% filter, which I'll show you in some time, you will get some results, because some companies will be out there which have excellent ROAs, right? So you can actually do that. But if you're trying to invest in 20, 30 stocks, right? In that case, you can put an ROA greater than 25%. So for most purposes, ROA greater than 25% is the filter that I use most of the times. Now, obviously, if I'm trying to invest, if I'm trying to diversify my portfolio, let's say I want to pick up some financial stocks, then I'm not going to keep ROA greater than 25%, because for the finance sector, we'll see it in the later slides, the ROA is usually lower, right? We'll understand the reason also for same, but the ROA is going to be lower. So some sectors, as I said, ROA is sector dependent. Some sectors which are asset intensive are going to have lower ROAs. Financials have low ROAs. Uh, Technology companies have high ROAs. So if you really understand this concept, the first thing is that the minimum value of ROA will depend on how many opportunities you're trying to look for and in whichever sector. So instead of going with an exact number, 25%, 15%, 30%, what you can do is, if you're trying to look into a particular sector, look at all the companies in that sector and list them out, and then you can sort them by decreasing ROA. So you have the companies with the highest ROA listed at the top, and then you know that the top 5 companies with the best ROA values in this particular sector are 1, 2, 3, 4, 5, and then you can further investigate those companies to see if they make good investment decisions. But in general, if you want to use this as a filter, you want to understand what a good ROA is, and you're not going sector specific, then uh, if you want to have a more strict approach, you can put ROA greater than 25% as a filter. If you want to get a wider list of stocks which you want to analyze further, you can put ROA greater than 15%. But don't go in for companies which have low ROAs, because when return on assets are lower, you need to keep some cushion, right? For companies which are doing 25% ROA, there is always a good chance that pandemic happens, some financial crisis happens, something goes wrong, and the ROAs can take a dip. We want to keep enough cushion that even in those troubled times, the ROA doesn't enter the negative territory, so the company starts losing money. Companies which have good ROAs will usually continue to survive in tough times as well. So look at the ROA of the peers compared to that, and that will tell you, because if you're trying to, let's say, invest in a pharma company, right, list all the companies in the pharma sector, which companies have the best ROA, sorted out by there. So you can pick the top 10 companies for further analysis, you can pick the top 20 companies for further analysis. So if I try to put a filter, I start with ROA greater than 25%. If I get too few companies, then I go with ROA greater than 15%. If I'm going sector specific, where I don't really have an idea what's the ideal ROA in this particular sector, then in those cases, I would list down all the companies in the sector and sort them in the ROA descending order. So that basically tells me which companies in this sector have the best ROA. Next thing is, how do we compare companies using RA? So I just discussed this. So when we are going to go to Finviz, and we basically will take a look at how we compare companies using ROA. So I just explained that, but I'm going to be showing you that on the platform as well. So those of you who are not familiar, this is the finviz.com site. I'll leave a link to this in the description. A lot of features on this website are free. You can get the paid version if you want, but the free version is good enough for what we are trying to do today. I'll leave a link to this, so those of you who are new, you can use the link and you can basically access this site. I have complete tutorials, a lot of things around Finviz, so you can look at my Finviz playlist on my channel, which will give you more information if you're just getting started with Finviz, because I have a tutorial on how to use this platform and how to use the screener and all that. So for now, I'm just going to head to the screener, and here, as I mentioned, let's say I'm just trying to look for good companies, right? So how do we basically look for companies, good companies with good ROAs? So here you can, I'm going to set a few framework filters. I call these framework filters first. So I'm going to look for companies which have a minimum market cap of 300 million. I'm going to look for companies only headquartered in the USA, and I'm also going to look at liquid companies. So I'm going to say the average volume should be over, let's say, 200,000 shares. Okay, so I have already placed some filters, and using these filters I have already narrowed down here to 2460 stocks. Now here you can see that one of the filters is ROA, and as I said, I start with an approach of over 25% ROA, right? So if you see here, now only 60 companies are getting listed. Now let's go through some of the companies. Apple, do I need to explain further? We just did a simple filter, right? And the best companies will start getting listed here. How many of these companies, think about it, have you heard about, are good companies? Apple, AGS Pharmaceuticals, AMD, A10 Networks. Then I mean, you may have heard of a lot of these, but I'm just going to call out the ones which I'm pretty sure that everybody's heard of. Crocs, then Domino's Pizza, right? eBay. So what I'm trying to tell you is that I'm using just one simple filter over here, which is ROA, and you can get hold of these companies which are basically doing really well, because these are the companies where whatever assets they have, they are able to generate a huge return, more than 25% on their existing assets. So that is very, very important, because if I hand you over my money and you can't generate returns on it, then why should I give you my money? So when we are trying to invest into stocks, we want to invest with the managements and companies which can generate a good return. And that's what's happening here. So we are looking at live data where the returns on assets are high enough. So the next thing we want to see is, how do you compare companies, right? So these are all companies which have uh, ROA greater than 25%. We already saw that. Now, basically, we are going to see how to compare. So I go to the financials tab, and here I'm going to sort this by ROA. So this became ascending. I'm going to make it descending by clicking once again. And now you see here, you can see that the highest ROA is with a company called SJD. Now, I've not heard of them. Then we have CRC, then we have Scales, and you can see here that the ROA is decreasing here. So if you really think about it, these companies are doing really well. Now, I would be careful with companies showing 300% above returns, and I want to see a history of the company for at least 3 to 5 years to understand if it's consistently had this kind of an ROA. If not, then I would stay away from them, because consistency is also required. But then you can see here that now this is a well-known company, Smith and Wesson brands, right? They are a well-known brand, and so you can see that these companies are the ones. eBay is known, Moderna is well known. So we get a lot of companies, good companies listed here, where the assets are being utilized really well. Okay, so this is how you compare companies. Now we are not just looking at ROA as a filter. That was the first thing we did. We used a filter greater than 25%. Now essentially we are trying to compare companies in terms of ROA, which is better than the other. So if you shortlist into 10 companies, you want to compare those companies and see which one is the best, just key in those companies here and see their ROAs, and you can compare which company has the highest ROA, which company has the lowest ROA. Now let's do one more thing. We will try to see the sector specific stuff. So let's say I want to look only at companies in the energy sector. Okay, let's try and do that. So now 5 companies are coming up. So all these 5 companies are satisfying 2 criteria, over 25%. And now I'm going to do another thing. I'm going to make this over 15%. Why? Because the energy sector is probably a sector which requires extensive assets. So their ROA in general is going to be on the lower side. So you can accordingly adjust this particular parameter. And now you can see that these companies are basically getting listed here. So I hope with all this you are able to understand what ROA is, how to use it on the Finviz platform, how you can compare different companies, and when you get into sector specific setup or industry specific setup, you can go to even very specific industries in here. So when you go into that, how do you basically compare companies? And if you don't know the exact value of RO, return on assets, just remove this filter, right? So let all the energy sector stocks get listed here. 132 stocks are being listed here. So let's narrow it down by industry. Let's put it as oil and gas midstream. Okay, I'll put it at oil and gas midstream. So if I put as oil and gas midstream, I'm getting 29 stocks. Now I want to compare these stocks, okay? Or basically, first of all, I want to get a feel what's the right ROA for this sector, right? If I'm trying to invest in this sector. So I know the highest one is at 22, and then I can look for some of the good names, the popular names, and see what their ROA is here. So I can see about 20 stocks are listed. Obviously, 0.8% ROA is on the very lower side. So I can see that, yeah, 22, 20% are exceptions. They're exceptionally high, but around 10%, somewhere between 5 to 10% would be a norm in this sector. So things which are probably below 5% are not doing that well. Companies which are above 5%, I can consider. Companies which are really on the higher side, again, as I said, I would go to previous years and see if they continuously are maintaining this kind of an ROA. Okay, so I hope the use of ROA and how you look out for ROA on the Finviz platform is clear to you. So now we'll head back to our presentation. We'll cover the rest of the topics there. So we just did this. We compared companies. We saw how you can access the Finviz platform, how you can basically compare different companies using the ROA. Then we already covered this. We just saw how we can look at the ROA on the Finviz stock screener. How to check the ROA also we just covered. So how can companies actually increase their ROA? Now this is very important. ROA is nothing but a ratio of net income and total assets, right? So one way is you increase the numerator, which is net income. And that's a good way, that's the ideal way of improving the return on assets. So if a company is increasing their sales, they're, let's say, exploring into different countries like Amazon is doing, or they are basically going into different business lines where the net income is increasing. They see prospects for growth. That is the ideal way to increase the ROA. The other way is a better utilization of the assets. So let's say you have certain assets which are not being utilized well and you lease out those assets. Let's say a company has 25, 30 buildings, but then it realizes five of the buildings are just always empty. They don't use it. So they've already, although they have it on their books, they may need it someday, but they essentially are not using it. So they can lease out those buildings for the next 4, 5, 10 years and generate income from that. So now those unutilized assets are being used and they are generating income, not via the direct operations of the company, but through indirect leasing. You're basically collecting rent on those buildings which were not doing anything. So there are different ways of improving the asset utilization. This will increase the net income. Again, ROA will go up. Let's consider another thing where you are in a position where you have created a brand and you're able to increase your prices. This is exactly what OnePlus did. The phone manufacturing company, they started with very cheap phones when they were entering the market, and then they started selling phones at prices which is very close to the flagship models. Apple has created a very, very valuable brand, and over a period of time, they're able to maintain their high prices and charge premium prices for their products because of their quality and the brand following that they have. So, if you're able to increase your pricing, that will increase your net income. Good way to increase your ROA. Then, if you keep on increasing your scale of operations and you can garner some economies of scale, that is another way to increase your net income. So there are different ways in which the operations, the sales, the brand, and good things about a business can be improved. If any of these factors are improving, and that results in an increase in these factors will usually result in an increase in the net income. If that is happening, then the increase in ROA is good. That's a good way of increasing ROA. Now, another way of increasing ROA, because it's a ratio, is if you reduce the denominator, right? And that is total assets. So, another way to do it would be if you start selling off your assets. But think about it, assets are things owned by a company which support their operations. So, you have to be careful in seeing that if a company is selling off its assets, is it really reducing its growth chances? Does the company feel that they have outgrown themselves, they have too many assets, and they have no capacity to grow? I would stay away from those investments because usually it is good to find companies which are hungry for cash, which want more and more cash because they have so much growth opportunities that they cannot find enough cash to invest and grow. You want companies which have the ability to grow. if companies are selling off assets because they are not in a position to utilize their assets, and that's because not because of any other reason, but it's because the competition is beating them, they are not able to basically sustain their operations or grow their operations, those are bad investments. So in those cases, although ROA will be going higher, but those will be bad investments. You really have to understand, if ROA has been going higher, why is it happening? Is it because of an improvement in the sales, the good things that I just discussed earlier, or is it because of the company liquidating its assets because it doesn't see a good enough use for them? The one exception to this would be companies where some companies will have multiple divisions, right? For example, IBM, they have multiple divisions. They are into mainframes, they are into cloud, they're into multiple lines of business. And usually these companies, they don't start with all these lines of business, so they'll start with particular lines of business. But over a period of time, what they'll realize is that, let's say they have 10 lines of business, 9 lines of business are doing really well, but there's one line of business which is continuously running into losses, and that's basically pulling down their balance sheets and income statements. So in those cases, these companies may decide to sell off that one division which is not doing well, because the company management realizes that we are not too good at running this particular division, or we are not able to beat the competition. So instead of having that loss performing unit attached to the company, it's better to sell it off and stop that bleeding or the losses that are continuously happening. In those cases, over the year in which that sale happens, the assets will go down, so the ROA will go up, and that is good. That is good because the company is not reducing the chances of its growth. It's still going to grow in its remaining 9 operations. It's only trying to wind off that one line of business which they are not able to maintain, which they are not able to compete with the competition, where they are continuously having losses. So in those cases, the reduction of assets is a good thing. So now we've looked at almost everything about ROA. Based on that, let's see how professionals use ROA. First of all, they're going to use ROA as a fundamental screener. So the first thing is that you want to pick up companies. You don't want to analyze every balance sheet. You want a quick way to understand, okay, which are the good companies, which are the companies that I should have on my watch list, and I can go deeper into them for further analysis. So ROA is one of the most important filters that you can use on any screener to come up with good companies. Secondly, we already just saw that the professionals will use ROA for peer comparison, because when you're trying to invest, ROA becomes one of the very important tools available to compare two companies. So, if I have two pharma companies, Gilead Sciences and AbbVie, both companies may look good because both have excellent financials. How do I compare these two? So, professionals are going to make use of ROA to compare these two companies and then figure out which one is better. And the third thing is, there's something called activist investing. And Bill Ackman, if you've not heard of him, just search about him. He's kind of an activist investor, and what these people do is they identify companies which are inherently good. They have good business models, they have good things going for them, but they have a terrible management, and it's only the way the company is being managed that the assets are underutilized, and the company is doing terribly bad. So in those cases, what these people do is they'll take a big position in the company, and then they will try to advise the management on how to run the company better. So these are companies which can really turn around. So when you look at companies, let's say for some reason the ROA on a company is low, right? But you know that in the past this company has had excellent ROA. Now ROA is coming down, and you realize that there was a management change which happened, and that caused the ROA to fall. Now you know that this particular company is not bad. It's only performing bad because of the bad management. So you can keep a lookout on such companies to see uh, when the change in management is about to happen, and that can really boost the ROA. So this is something called activist investing. You can search more around it, so you'll understand how professionals use it. Because Bill Ackman, as I mentioned, he is a professional hedge fund manager. He manages, I think, more than 10 billion worth portfolio right now. So this is one of the ways in which this can be used. Now, finally, let's come to ROA in different sectors. I've already mentioned this. Sectors can be asset intensive, or sectors can be very low on assets. So wherever you have sectors which are capital intensive, right, which require a lot of assets, the ROA is going to be lower. Why? Because in that formula which we saw, the denominator is going to be huge. So if the numerator, even if the earnings are in billions and billions of dollars, if they have a lot of assets on their books, which they have built over a period of time, obviously the ROA is going to be lower. So ideally, don't try to compare two companies in different sectors using ROA, because it's like comparing apples to oranges. Okay, so you want to stick to the basic funda that you're going to be using ROA to compare companies within the same sector. And if you don't know anything about a particular sector, then you sort out all the companies based on ROA and then evaluate which companies have the best ROA. Obviously, companies with very low ROAs you will drop out, but companies with very high ROAs, you need to investigate them further to really understand what is the reason for those high ROAs. And financial companies, I mentioned this some time back, will have low ROAs. Reason is because understand, how does a bank make money? On one hand, they receive deposits from people like you and me. We save money, so we deposit our money in the bank, on which we get paid some interest. And the bank uses that money, a portion of it, and it loans it out to other people. And people who take loans, they pay interest to the bank. Now, always the interest at which you get a loan is more. So you pay more to the bank when you take a loan, and you receive less from the bank in terms of interest payments. And this is valid across countries, across the globe. The actual rates may vary, but that's the concept. And the difference between the two rates, the rate at which a bank receives interest and the rate at which the bank pays interest, is basically the profit for the bank. And these rates cannot vary by much. I mean, if you consider in the United States right now, you can get loans for about 2%, 3%, and banks are literally not paying any interest on your savings or checkings account right now, right? So the difference delta is 2 to 3%, and that's going to be their ROA. ROA in fact will be lesser than that most of the times, because the bank has to also make payments for its operations, for all the staff, for all the buildings and other things. So that is another expense. They have to take off their expenses out of that. Now banks do make more money because they also go into the credit card business, and the rate of interest on credit cards is very high. It's about 20%, 15%, 16%, depending on the kind of card that you have. So there's a mix, but in general, banks will have low ROAs. And the reason I mentioned, because they mainly work on the difference in the interest rates that they receive and they pay out, and those don't usually tend to be very high. It's a very competitive world out there, so they cannot have. I mean, if one bank tries to give loans at 10% interest rate, there's another bank ready to give at 3%. Nobody's going to go to the bank which is giving loans at 10%, right? So that is the reason why banks have low ROA. Financials in general have low ROA. Now, finally, we come to the one limitation that ROA has, and I've mentioned it a couple of times, but I'm going to mention it directly now. Do not use ROA to compare companies across sectors. Because if you look at a tech company and if you look at a bank, you'll always feel that tech companies are doing better than banks. And that may not be the case. Why? Because a bank is a very different investment. A financial institution is a very different investment from a tech company. So don't try to use ROA to compare companies which are in different sectors, because you'll get very different results. And it doesn't necessarily mean, I mean, if you see the lowest ROAs of the not so good companies in the tech sector, their ROAs would be better than the best banks. But it's obvious that the best banks are not actually worse investments than the average or the below average tech sector companies. And another drawback of ROA is that companies which are capital intensive, which require a lot of assets, right? When they are in the phase of investing money to create their assets, to build their assets, during those years, those companies will not be able to generate any income, and only the asset sides, total assets will keep on increasing. For example, and a perfect example of this is Intel. Now, Intel just came out a couple of weeks back that they are going to invest about $25 billion in the next year into building new plants and foundries for the uh, improving their chip designs and creating faster chips. So if you think about it, it's a good move because the company is investing into their future. But what's going to happen over the next 1 or 2 years? they are going to invest more and more money, and those plants will not be ready within a year. Those plants will take 2 3 years to become fully operational, and till the time they are not fully operational, they are not going to generate any net income. So the assets are going to keep going up and up in value, but the the income may not start immediately, right? Because it takes some time when even when the plants are ready to actually produce the chips, to design the chips, to produce the chips, and then have them marketed out. It takes time. So for a temporary phase in between, for a couple of years, you may see that the ROA on such companies is falling down. And if you are blindly using ROA as a filter, what's going to happen is these companies may get dropped out. So for companies that have historically had good ROAs, if you all of a sudden see that there is a drop in the ROA, see if they are in this growth stage. If they are in this growth phase where they're trying to invest money and they're creating more and more assets for future growth, because that's a good sign. That's a good sign that a company is investing into their future. If you otherwise see the ROA falling because of the management handling the assets poorly or something going wrong with the company, then ROA provides you with a very clean picture. So this is all about ROA. So I hope I have covered all details regarding ROA. We covered a lot of details here. And once you go through these details, you will have both the things. One, you will have enough information around ROA, so you don't have to hunt for information here and there in bits and pieces. I've tried to put in all information that I know and the way I use it on ROA. Second thing is return on assets is a key metric that you can use for your personal investing and trading decisions. So if you're trying to invest your own money, if you're trying to learn to invest your own money or even trade on the shorter time frame, it's always better to take trades on companies which are fundamentally good, right? So I usually end up selling options, and I am very comfortable selling options on fundamentally good companies, because if I get assigned on my puts, I just buy the shares on a good company at a very deep discount. So that's a very good strategy which works out nicely in the long run. And I hope this video was useful, and you can use this practical information in your investing, in your trading, and otherwise your analysis of the stock markets. If you have any comments or suggestions, please leave them down in the comment section. I'll definitely respond to you. If you have any queries, if there's something you did not understand, leave that down in the comments. I'll try to help you on that as well. Please share this with your family and friends if you liked it, and subscribe to the channel if you've not already done so. Spread the word, because this information I'm giving it out for free. It takes me a lot of time to compile this information, and basically it's the years of experience that I'm trying to put in, because you can find these formulas and other things everywhere on the internet, but how to apply these formulas and how to really understand what these ratios mean, how to utilize them practically, is what I'm trying to convey to my viewers. So the only thing that I ask in return is that please give your feedback, like the video, subscribe to the channel, and share it with as many people as you can. Thank you for your time, and I'll catch you guys in the next video.